Drive through any suburban neighborhood on the Saturday morning. Count the pickup trucks sitting in driveways. Full size, lifted, chrome everything, pristine paint jobs without a single scratch. Now look closer at those truck beds. Empty, spotless, completely untouched. The bed liner looks factory fresh because it essentially is. You won't find tools, dirt, or scratches from hauling lumber. These trucks haven't carried anything heavier than grocery bags since the day they rolled off the lot. There's a term for these vehicles in automotive circles: pavement princesses. Trucks that exist purely for the image of capability without ever being used for their intended purpose. They're the vehicular equivalent of buying a commercial kitchen and only using the microwave. Here's the uncomfortable part. Those pavement princesses cost their owners somewhere between $65,000 and $95,000. The monthly payments run $800 to $1,400. Insurance adds another $200 to $350. Gas for a vehicle getting 14 miles per gallon in a world of $4 fuel adds $400 or more monthly. We're talking about $1,500 to $2,000 per month for the privilege of owning a work truck that never works. And the owners of these trucks are absolutely convinced they got a good deal. This is the pavement princess trap. It's one of the most effective wealth destruction mechanisms in modern America. It drains bank accounts across every income bracket, while the people paying these notes genuinely believe they're making practical decisions. The psychology behind this trap reveals something profound about why so many families earning good incomes still feel perpetually broke. Let me show you exactly how this trap operates and why it catches so many people who consider themselves financially responsible. The American pickup truck has undergone a fascinating transformation over the past 3 decades. In 1990, trucks were working vehicles. Contractors drove them, farmers drove them, tradespeople drove them. The interiors were basic, sometimes Spartan. Vinyl seats that could be hosed down, minimal electronics, practical everything. The average transaction price for a new vehicle in 1990 was around $15,000. Trucks fell right in that range. They were affordable tools purchased by people who needed their capabilities. Fast forward to today. The average transaction price for a new pickup truck has exceeded $58,000. Fully loaded models routinely crack $80,000. Some configurations approach 6 figures. The Ford F-150 Limited starts above $75,000, while the GMC Sierra Denali Ultimate commands similar territory. Ram's luxury trims compete for the same dollars. These aren't work trucks anymore. They're luxury vehicles wearing truck costumes. The interiors feature heated and cooled leather seats, panoramic sunroofs, 14-speaker premium audio systems, and screens larger than mini laptops. The technology rivals anything in the luxury sedan segment. The fit and finish competes with European imports costing similar money. Manufacturers figured out something brilliant. Americans have an emotional connection to trucks that transcends utility. Trucks signal capability, self-reliance, and rugged individualism. These associations persist even when the truck never leaves paved roads and even when the owner couldn't change a tire without calling roadside assistance. By luxifying the truck experience while maintaining the rugged exterior, manufacturers created the perfect status product. Owners get to feel like capable, practical people while enjoying leather seats and massage functions. The truck provides psychological benefits that have nothing to do with actual trucking. This emotional engineering comes with a massive price tag that most buyers cannot actually afford. Let me walk through the mathematics of a typical pavement princess purchase, because the numbers reveal how devastating this decision becomes over time. Consider someone earning $75,000 annually, which puts them solidly in the middle class. They decide to buy a new full-size truck. Nothing too crazy, just a nicely equipped model running about $62,000 after destination charges and dealer fees. They put down $5,000, which depletes most of their savings. The remaining $57,000 gets financed at 7% interest over 72 months because that's the only way to make the payment manageable. Their monthly note comes to $975. Insurance for a full-size truck runs about $2,400 annually for an average driver. So add $200 per month. Registration and taxes vary by state, but figure another $50 monthly when averaged across the year. Fuel for 15,000 annual miles at 14 miles per gallon and $3.80 per gallon costs roughly $340 per month. The all-in monthly cost of operating this truck exceeds $1,565. On a $75,000 salary, after taxes and typical deductions, monthly take-home pay lands around $4,800. This truck consumes nearly 33% of available income. 1/3 of everything this person earns goes to a vehicle that sits in their driveway looking impressive. The standard guideline suggests keeping total transportation costs below 15% of gross income. This purchase nearly doubles that threshold. Financial planners would classify this as severe overextension, but dealerships approve these loans constantly because the truck itself serves as collateral. Here's where the trap really snaps shut. After 6 years of payments totaling over $70,000, what does the owner have? A truck worth approximately $28,000 to $32,000 on the used market. They paid $70,000 in payments plus $5,000 down, totaling $75,000. They received $30,000 in residual value. The net cost of owning this vehicle for 6 years was $45,000, or $625 per month in pure wealth destruction. That $625 monthly, invested instead in index funds averaging 8% returns over the same 6 years, would have grown to approximately $57,000. The true cost of the truck wasn't $45,000. It was $45,000 plus $57,000 in opportunity cost. Over $100,000 in wealth either destroyed or never created for a vehicle that hauled absolutely nothing. The pavement princess trap operates through several psychological mechanisms that override rational financial analysis. Understanding these mechanisms is the only way to escape their pull. The first mechanism involves identity signaling. Trucks communicate something about their owners. They suggest capability, strength, and self-reliance. These associations exist even when completely disconnected from reality. The accountant, who's never towed anything in his life, still feels more rugged stepping out of his F-250 than he would exiting a Camry. Manufacturers understand this deeply. Their advertising shows trucks conquering mountains, fording rivers, and hauling impossible loads. The owners absorb these images and unconsciously associate themselves with that capability. The truck becomes aspirational identity rather than transportation. This identity investment makes the purchase feel essential rather than indulgent. You're not buying unnecessary luxury. You're buying capability you might need someday. You're buying readiness for situations that may never materialize. The potential utility justifies the actual expense. Of course, that potential rarely converts to reality. Studies of truck usage patterns consistently show that the vast majority of pickup truck owners use their truck beds fewer than 12 times per year. Many go months without placing anything in the bed at all. The capability exists entirely in theory. The second mechanism involves social proof and normalization. When everyone in your neighborhood drives trucks, truck ownership feels normal and expected. When your coworkers drive trucks, showing up in a sedan might feel like showing up underdressed. When your social media feed fills with friends posting their new truck purchases, the pressure to participate intensifies. This normalization makes financial irrationality invisible. Everyone's doing it. Everyone seems fine. The guy next door bought an even bigger truck, and he's still making his mortgage payments. The behavior appears validated by consensus, regardless of whether that consensus leads somewhere good. What nobody sees is the stress behind those payments, the arguments about money, the second jobs taken to stay afloat, the retirement accounts sitting unfunded, the emergency savings that never materialize. Everyone projects financial confidence while privately struggling. The social proof is a collective illusion maintained by shared reluctance to admit overextension. The third mechanism involves payment focusing rather than price focusing. Dealerships train buyers to think in monthly payments rather than total cost. The finance manager asks what monthly payment works for your budget, then structures a deal to hit that number, regardless of what it costs overall. Want a $65,000 truck on a $600 budget? Easy. Extend the loan to 84 months. Your payment is $598. Never mind that you'll pay $15,000 in interest. Never mind that you'll owe more than the truck is worth for most of the loan term. Never mind that 7 years is an absurdly long time to finance a depreciating asset. The payment focus creates an illusion of affordability. If the monthly number fits somewhere in the budget, the purchase feels reasonable. The total cost becomes abstract. spread across years of future payments that don't feel real in the present moment. This is exactly how people earning solid incomes end up broke. They make a series of payment-focused decisions that each seem individually manageable, but collectively consume all available resources. The truck runs $975. The house takes $2,200. The other car cost $450. Student loans claim $380. Before long, every dollar is allocated before it arrives. The fourth mechanism is perhaps the most insidious. It's the sunk cost acceleration that happens after purchase. Once someone owns a Pavement Princess, they face constant small decisions that compound the original mistake. The truck needs upgraded wheels because the factory wheels don't look aggressive enough. That's $3,000. It needs a lift kit because stock height doesn't command enough presence. That's $5,000 installed. A tonneau cover for the bed that never holds anything runs $1,200. Window tinting, aftermarket exhaust, running boards, bed lighting, each addition seems small relative to the original purchase. Each addition deepens the financial hole. Truck owners often spend an additional $5,000 to $15,000 on modifications within the first 2 years of ownership. These modifications add minimal resale value while providing maximum emotional satisfaction. The truck becomes a project, an expression of identity, a hobby that happens to also be transportation. Meanwhile, the modifications make the owner even more attached to the vehicle. Selling it would mean losing all that invested customization. The sunk costs create psychological barriers to the only financially rational decision, which would be getting rid of the thing entirely. There's a fifth mechanism that keeps people trapped even when they recognize the mistake. It's called the negative equity cycle, and it might be the most financially devastating pattern in automotive retail. Here's how it works. Someone buys a truck for $62,000. After 2 years of payments, they've paid about $24,000, but the truck is now worth only $42,000. They still owe $48,000 on the loan. They're $6,000 underwater. They're tired of the truck, or their circumstances have changed, or they've realized the payment is crushing them. They want out. But selling the truck means writing a $6,000 check to cover the difference between what they owe and what it's worth. Most people don't have $6,000 lying around. The dealership offers a solution. Trade in the truck and roll that $6,000 negative equity into a new loan. Of course, they're not going to roll negative equity into a cheaper vehicle. That doesn't work mathematically. They need to buy something more expensive to absorb the negative equity while keeping payments similar. So they trade a $62,000 truck they couldn't afford for a $70,000 truck they really can't afford. The negative equity gets buried in the new loan. The payments stay roughly the same, maybe slightly higher. They feel like they've solved their problem. In reality, they've made everything worse. They now owe $6,000 more than the new truck is worth from day one. The cycle continues. Each trade digs the hole deeper. I've seen people carrying $15,000 or $20,000 in negative equity, unable to escape because they need to write a massive check to get out from under their vehicle. The dealership profits on each transaction. The lender profits on each loan. The customer sinks further into automotive debt with every solution they're offered. I want to introduce you to 2 hypothetical families to illustrate how vehicle decisions compound over time. Both households earn $130,000 combined. Both live in similar neighborhoods. Both have 2 children and similar lifestyles. The only difference is their approach to vehicles. The first family owns 2 vehicles worth a combined $95,000. The husband drives a loaded pickup truck. The wife drives a 3-row luxury SUV. Their combined monthly vehicle costs, including payments, insurance, and fuel, exceed $2,600. That's $31,200 annually going to transportation. The second family owns 2 vehicles worth a combined $38,000. Both are reliable 3-year-old Japanese sedans purchased used. Their combined monthly costs for payments, insurance, and fuel total $950. That's $11,400 annually going to transportation. The difference between these families is $19,800 per year. Let that number sink in for a moment. Over a decade, the first family spends $198,000 more on transportation than the second family. Invested at 8% returns, that difference grows to approximately $310,000. Over a 20-year period encompassing most of a career, the gap exceeds $900,000. The second family retires with nearly $1 million more than the first family. Their cars got them to work just as effectively. Their children reached school just as reliably. Their groceries made it home just as safely. They simply refused to participate in the pavement princess trap. Both families would describe themselves as middle class. Both families would claim similar financial pressures. But only one family is actually building wealth. The other is transferring wealth to auto manufacturers, dealerships, insurance companies, and oil refineries. The psychological brilliance of the pavement princess trap is that victims rarely identify as victims. They see themselves as practical people making reasonable decisions. They genuinely believe they need the truck's capabilities, even when those capabilities go entirely unused. The identity attachment is so strong that questioning the purchase feels like questioning their judgment, their self-image, their entire sense of self. This defensiveness protects the trap from scrutiny. Point out that someone's truck never hauls anything, and they'll immediately list hypothetical scenarios where they might need it. What if they help a friend move? What if a hurricane requires evacuating with supplies? What if they decide to buy a boat someday? These hypotheticals justify perpetual readiness for situations that may never occur. The truck becomes expensive insurance against imaginary needs. The premiums run $1,500 monthly, but the policy never pays out. Here's a question worth asking. How much would it cost to simply rent capability when you actually need it? Home Depot rents pickup trucks for $19 per hour. U-Haul rents them for similar rates. A full day with a rental truck runs maybe $100 to $150, including fuel. If you used rental trucks 12 times per year, which exceeds what most Pavement Princess owners actually need, you'd spend roughly $1,500 annually. Compare that to $18,000 or more annually to own the truck. You could rent a truck every single weekend and still come out massively ahead compared to ownership. The math isn't even close. But people don't rent because renting doesn't provide the identity. Renting doesn't sit in your driveway signaling success. Renting doesn't make you feel like the capable person you want to be. The psychological benefits of ownership exceed the practical benefits by such a wide margin that the financial comparison becomes irrelevant. The escape from this trap requires confronting uncomfortable questions about identity and status. It requires admitting that vehicle choice often reflects ego rather than need. It requires accepting that the neighbor's opinions about your car don't actually matter. It requires recognizing that true financial security feels better than looking successful. Here's a practical framework for evaluating whether you're in the pavement princess trap or heading toward it. First, document your actual truck usage for 3 months. Every time you put something in the bed, write it down. Every time you tow something, write it down. Every time you use the 4-wheel drive, write it down. At the end of 3 months, examine the list honestly. If your list is short or empty, you don't need a truck. You want a truck. That's fine, but be honest about what you're buying. You're purchasing identity and status, not utility. Price that purchase accordingly. Second, calculate your true cost of ownership. Include payments, insurance, fuel, maintenance, registration, and depreciation. Divide by 12. That's your monthly transportation burn rate. Compare it to 15% of your gross monthly income. If you're over that threshold, you're overextended regardless of how manageable the payment feels. Third, run the opportunity cost calculation. Take your monthly burn rate above what a reasonable vehicle would cost. Multiply by 12 to get annual excess spending. Compound that at 8% over your remaining working years. The resulting number represents wealth you're choosing to destroy. Fourth, ask yourself honest questions about identity and ego. Would you feel lesser driving a modest sedan? Would you worry about others' perceptions? Would you feel like you'd lost something important? These feelings are valid, but they're also expensive. Understanding what you're really buying helps you decide whether the price is worth paying. The automotive industry has spent billions engineering the emotional connections that make pavement princesses so appealing. They've carefully cultivated associations between trucks and admirable qualities. They've made luxury trucks feel like essential equipment rather than indulgent toys. Escaping this engineering requires conscious resistance. It requires recognizing that your vehicle is a tool, not an identity. It requires understanding that actual wealthy people often drive modest vehicles because they prioritize building wealth over displaying wealth. Most importantly, it requires accepting that financial security provides deeper satisfaction than any status symbol. The most successful people I know drive vehicles that would surprise you. Paid-off sedans with modest features. Used SUVs purchased 3 years old. Practical transportation that moves them efficiently without draining their accounts. They've escaped the pavement princess trap entirely, often because they recognized it for what it was before stepping into a dealership. Their driveways look less impressive than their neighbors. Their garages don't house gleaming chrome monsters, but their investment accounts tell a different story. Their retirement projections paint a different picture. Their financial stress levels reveal a completely different reality. The pavement princess sits in the driveway, announcing success to everyone who passes by. Meanwhile, actual success is being built quietly by people who refuse to play that game. They're channeling $1,500 monthly into assets that appreciate rather than depreciate. They're buying their future freedom instead of buying the appearance of present capability. That truck will be worth $15,000 in 10 years, regardless of how impressive it looks today. The investments purchased instead of truck payments will be worth something dramatically different. One final thought worth considering. The pavement princess doesn't just cost money, it costs time. Those 7 years of payments represent 7 years of mandatory employment. 7 years where quitting isn't an option. 7 years where financial flexibility doesn't exist. The truck payment becomes a chain linking you to whatever job covers it. Financial independence isn't just about accumulating wealth. It's about reducing mandatory expenses to the point where work becomes optional. Every unnecessary expense extends the timeline to freedom. The pavement princess might add 5 or 10 years to your working life compared to driving something modest. That's not just money. That's years of your life traded for the appearance of capability you never actually use. The choice is yours to make, but at least now you understand what you're actually choosing between. It was never really about the truck at all.